All right. How's everybody doing this morning? A nice Tuesday morning. It's beautiful outside. Looks like we might get a little rain, but it's not raining in the market. No rain. Make it rain, baby. Make it rain. Well, we're going through a little drawdown right now, and everybody's a little pooped, right? Or a little pooped. Little upset about the fact that the market's drawn down a little bit, but this is normal behavior, right? We know that markets go up, they go down, they go up, they go down, they move around. So, you know what? Don't freak out. Just realize that's the way the nature of the beast is. And so we have to work with that. And so inside of that window. Now, today I mentioned that we're going to be looking at the reinvestment of dividends. Now, last week we talked about my portfolio, and we talked a little bit about some of the things going on in the markets. And we started looking at portfolio stuff. I showed you my portfolio, and I had $7,000 that was sitting on the sidelines waiting to be put into the market, right? And I was going to talk about reinvesting those 7,000. Well, since then, I picked up another, I don't know, a little 10, 11, 12, 13,000. So we're up to 20,000 right now, sitting on the sidelines, cash that's been paid out to me that I need to reinvest into the market. So we're going to go through and look and see if there's not any opportunities to put some money in on these dips. Now, we want to be smart and strategic about this. When we get a dividend, you don't want to drip. And I've mentioned that more times than I can shake a stick at. We don't want to be dripping into our dividends. The reason you don't want to drip them is because they just automatically throw them right back into the same thing you just took them out of. Well, what's the point of that? I mean, if you're just going to pull them out and throw them right back in, then why take them out in the first place? Just leave them there, and then you don't have to pay taxes on them. All right, because every time you pull money out in a dividend, you have to pay taxes on it. It's income. So if you're not going to take it out and spend it and go use it for purposes in which it was designed, which is to give you income, and you're just going to reinvest it back into the market, well, be strategic about your reinvestments. And that's okay. That's what I like to do. I like to take the money out as a dividend and then hold on to it until there's an opportunity to buy something better at a lower price. Buy the dips, right? Buy the pullbacks. Look for opportunities. Look for markets that are on the rise. Don't just throw it right back into the same market you just pulled it out of. It makes no sense. So don't do that. All right. You'll be much better off if you can be a little bit smarter, a little bit wiser about your reinvestments. And that's what we're going to be talking about today. We're going to be focusing on reinvesting our dividends. And before we do that, I'm going to show you the little reinvestment calculator. I'm going to show you the amount of money I have. I'm going to show you my portfolio, and we're going to go through the portfolio matrix. We're going to look at some markets. But before we do that, I have a couple of little things I want to talk about. Two things in particular. One, well, actually three. I want to look at the news and I want to talk about that. So we're going to look at three things. The first thing is I want to look at my portfolio. So portfolio is the first thing we're going to do. We're just going to go down through some of these markets that we have positions in and take a look at them. All right. Two, we're going to talk about, I want to talk to you about the government's ownership of stocks, government stock ownership. Okay. And then three, we're going to go through and we're going to talk about the news. And of course, that's because we got a lot of Fed government crap going on right now. And then four, we're going to go over and we're going to look at our portfolio and we're going to talk about reinvesting. All right. So I got myself some notes here. Make sure I don't get lost and off on tangents, which I have a tendency to do. Claire says that I use a sentence or a paragraph where a sentence will do. So I apologize for that. So we're trying to make it quick and painless. All right, let's jump in here and take a look at some of these markets that we're excited about. And the first one we're going to take a look at is, well, let's take at the ones that we've got positions in. So let's first look at UNH. This is United Health. And United Health, we put in here we bought 3 long calls. Just very simple. I mean, the market was starting to look like it was starting to rebound. It was going to, from this big major drop. And so it started to keep going up. We're making good money. We're up $9,000 on it. Now, if we come in here and go to just this chart, you can see down here. Can you see the total gains? Yeah, I'm not in the way of everything. All right. And then we decided we were going to go ahead and sell 3 covered calls against this because we didn't feel like at the time right here that the market would rally up and zoom up past that red line. And it doesn't look like it's going to. It's falling right in line with what we were expecting. And so we're up another $600 on top of our $900. And that's just from selling our covered calls right there. We sold 3 of those, and we picked up another. Right now it's $600. So that's pretty cool. And that looks like how much we got left in there. Well, we've got everything. We got 100% of everything back. We got 93.29%. All that's left is $43. I always have a rule of thumb that says once you get to the point where you've only got $50 left, take that baby off, because now you got everything to lose and nothing to win. So what happens if the market rallies really hard and goes up above the red line? Well, then you lose it all. So if we had one big spike bar or something that shot up there, well, we got everything to lose, all $648, and the only thing we got to win is $43. So we need to take that off. All right. So everything to lose, nothing to make. So we'll just see if we can mark it out of that. I don't know if it'll let me. There we go. We got that out. We took our $550, stuck that in our back pocket, and now we can go do whatever we want with it, right? We can go buy things with it. We can go and reinvest it in something else, whatever we want to do with that $500. We just took $500 off. Now we could put another, we could do it again. We'd probably rather be doing it on a green bar than a red bar, but we could look at it anyway, just for fun, to show you how we do it. Come out here to 38 days, go down to the options chain, slide down here to some calls, and we'll just do it right at the money right now. And we'll just say we're going to sell one of those. We're actually going to sell 3 of them. Let's just do one right now to price it out. But we don't want to sell it right at the money. We're going to come out here a little bit, give it a little bit of breathing room. That would be $800, $600. Implied volatility is at 43. I wish that was a little higher. If we had a green bar, it'd be a little higher. But right now the market's flushing out, so it's down. Probability of being in the money is 76%. So that's really good. If you go up one more, that's an 80% chance the probability of being out of the money. So that's, you got over an 80% chance of making your money on that one, mathematically calculated. All right. So you come in here and you say, well, that'd be $475 over the next 38 days with a 80% chance of making money. That's pretty good deal. All right. And how much would you make? Well, on here, it looks like you would make about margin required 0, receive $475. Well, that's how much you would receive. Let's see. We want to do 3 of them though. So because we're long 3, right? We have buy 3 calls. So we're going to do 3 here. So there we go. So what would that be? Actually, $1,424, which is more money than what we made last time, which is $550. So that's pretty good. And we're further out of the money. So the question is, we got a little bit longer time. Do you think the market's going to stay below that red line until that purple line? If it goes up and starts going up above that purple line, that red line, well, then we're going to lose money. We're not going to make our $1,425. Anything above that line, we'll lose. All right, we'll lose our entire $1,400. Yet we won't receive that. We'll have to give that all back, plus whatever goes above, these markets will make. And then they could, if we're not careful, if it goes way up above there and hits that purple line above there, they could take away our 3 long calls here. We'd have to sell those 3 long calls. We don't want to do that. And they'd take the losses out of our profits there. So we have profits here. You can see, let's see, positions, $9,772. Now, if the market went way up there, this would make more money, right? But then they would take that $1,400 out of our hide, out of this right here, although we'd probably make it right in here. So we make it in here. That would be $5,587 minus $1,425, and then we wouldn't make anything above that. So it would be okay to do that. I don't think we would be sweating bullets if that happened, but it's not ideal. We'd rather just have this stay down here. Actually, we wouldn't. We'd like to have it go up there and touch right there, and then we could sell it right here. That would be the ultimate, as if this thing went right to there. That would be the ultimate right there. And we get to keep all $1,400 here, plus we get $5,000 out of the rise in price on our long calls. So that would be pretty cool. All right, so we'll go ahead. Why not? Let's just put that in there. I wish it wasn't quite so far out. 38 days, but that's what's giving us the 1,400. If we go to a shorter time frame, let's go 24 days, but let's see if there's any volume. See, there's no volume, no open interest, implied volatility. I don't know. I think we're better off doing this one here. The thing is, we'll get most of the decay towards the end. We won't get as much decay out here. And the market's already fallen. If we get like another day or two down here, break those blue lights, then it turns and starts to go back up. That might not be as good for us as we want, because most of the decay is going to come in this area right out here. It'll hang on to its value all through here. This will all be, it won't lose much money in here unless, of course, this thing tanks. If this thing turns and I don't know why I can't ever click. Too many clicks. If this thing just tanks and comes all the way down here, then of course we'll make all our money, but we'll lose it all on this one. So I don't know. It just feels a little bit far out to be 38 days selling this thing right now. But I don't think the markets are going to be rallying anytime super big anytime. Let's just go ahead and put it on there. So we're going to sell it. So we're going to go to the bid with 475. Ooh, spread is 165 bucks. I didn't see that. 75. Sorry, we can't do that. All right, we're going to have to come back another time when the market's not so crazy. Maybe this afternoon. All right. So we'll come back to our positions, go to the all positions. The next one is Tilray. Now, Tilray is a weed stock, right? Because we had all that, Trump posted that he was going to take CBDs off of the Schedule 1. And so the markets took off like a rocket ship. And right in here, I was like, well, I think maybe not so much. So we put on this little order here, and it went above us there for a little while, but then it flushed back down. So we're back in good shape. We're up $700. Paid 14, received 220. So the max we could make on this thing, it paid 19. Market value is 150. Received 2. So there's a lot more money we can make in here. We're only at $700, and we could make, well, let's see, 14, 15, 16, 17, 18, 19, 21, 22. No, we're about max profit, aren't we? Let's go to all. No, let's just go to chart. Oh, we're at 87%. There's not much left for us to make. A little bit, and it looks like it's falling. I don't think we need to sell this one. I mean, there's an extra 100 and, well, I can't. How much money is there left in there? Cost base is 14,800. We're at 700. There's an extra $100 in there for us if we want to hang on to it, and I think we can for that extra $100. It's that same thing. You got everything to lose, nothing to make. $700 to lose to try and pick up that extra $100. But look at the market. I think we're in such a good position here that I don't think there's much chance that it's going to rise above that red line by the purple line. And that's the game we're playing. It's just got to stay below that red line right there. It's got to touch this purple line below that red line. If it does that, we'll get that extra $100. And I think that looks like a pretty good chance. It's not going to go shooting all the way back up there. All right. Hold on a second. I got to drink. I'm losing my voice. All right, so I think we're in good shape there. We're just going to keep that one for now. Let's go see what else we've got over here. Canopy Growth. This was another weed stock that we talked about, and we're in the same situation there. The market's flushing out on this thing. We bought 15 calls. Let's see what we did here. Did we take notes? I should have taken notes. No, I didn't take any notes. Of course not, Land. You wouldn't stop to take time to take any notes. Let's see. We're up $557, 14% on our long call when the market's flushing. We're up 66% on our, what did we do here? Call. Oh, we sold one, we bought one. So that's just a spread right there. We bought a call and we sold a call. All right, so we're up $400 on that, and the market's flushing. So that one's at 66%. There's still a lot of money to be taken in that one. I think we need to take this one off. I don't think that's gonna. Let's liquidate that one. So we're gonna liquidate that option. Take our $157 off. 82. We're gonna have to go to. Ooh, look at the spread on that. Is that why that's killing us? Oh, receive. I think I got the wrong one. I don't want to take that one off. I want to take this one off. Let's just do it right here. Liquidate the option. There we go. No, that's not right. What the heck is going on? Oh, days till expiration. Oh, that's just a really long call option that we put in there. 458 days. I don't know if canopy growth. We put that on there as a long leap just to see what canopy growth was going to do for a whole year. I guess we better not take that off. We better just leave that on there. It's up $157, but the market's flushing back down. Well, they'd have to do something within the next year on this canopy growth stuff, get that market to rally again. How much should we put into it? $1,000. I said we hang on to it. I mean, we're making $400 to pay for it right here, just off of this covered call. Then we can do more covered calls against it. I mean, we can do these little spreads against it as long as we want. I think we keep it. Seems to be a good little cash cow. Let's just hang on to that little cash cow. We'll just keep selling options against that canopy growth on the downside. We might not make much on the option, but the max we can lose is $1,000. But we can sit there and sell options against it all day long. Do it again. 400, another 400, another 400, another 400. We got 458 days. We can do that. Every 30 days, we can make another $400 against it. Yeah, it'll just be a little cash cow. We just hang on to that thing. Don't worry about it. Don't worry about it. All right, let's come in here. That was canopy growth. Next one we have is BlackBerry. What do we got left in BlackBerry? We're still long. We took our options off up here, took max profit. Our shares are starting to flush back down. There's right here. I almost want to just take the money off in case this thing keeps flushing. The thing is, it's already flushed back down to the 50% level. So we're already right here in the Fibonacci sweet spot. So this is where we'd expect this market to kind of catch and start to go sideways and maybe start adding into some for the next leg up, right? So if we look at this from a longer term standpoint, this would be drive 1, counter trend, drive 2. Maybe we're in drive 2, little counter trend, and then continue the drive 3, drive up. So we're kind of not going to sell these shares out just because we might be wanting to add into some shares in here. So if we get a nice little pattern in here, gives us an indication the market maybe go sideways a little bit through here and then go sideways and then maybe start to rally back out. We'll start adding into some positions here for an increased valuation of BlackBerry. How's that? All right, and Caterpillar. We don't have any positions on Caterpillar, but look at that baby go. I wanted to pull that up and put it in our watch list. All right, BlackBerry. The next one is Grow Generations. We got $250 on this one, and we just did the same thing. We just sold some options against just a spread up in here. What I call a chicken wing, right? Okay, it's the upper wing of a iron condor. So we put that on there, and then the market just flushed right out, just like we anticipated last time we did this. We're up $250. We received 6. So what are we at? Let's just look at the chart. We are at 33% gain. And I think that thing's still headed down. So there's no reason to sell it at this point. So we might as well hang on to it and see if we can't get more than 33% of our money back. All right. So we're in good shape there. Let's go see what else we have. Positions, all, chart, all. Let's see. So that one is Grow Generation. Grow Generation, Canopy Growth. We already looked at that one. Aurora Cannabis. Did we look at this one? Nope. Oh, this was just a long call. What did we do? 458. 458. We're down how much? Just the chart. $125. We didn't put our long. Why didn't we put our this is a leap. We should have had our we should have had our 38 days. It's the best we can do. Look, we got no volume today. We got some good open interest out here. $30 on the spread. We could sell that out there. Pick up. They're only going to give us $20. That's why we don't have one. There's not any money in it. Why in the heck are we even in this damn market? Let's exit all. Exit chart options. Yes. Kill it. Okay. Get me out of that thing. Close that dog out. Okay, so let's come back in here. Which one was that? What did I just close out? Just closed out ACB. ACB. So let's just take that out of our list. Delete chart. Bye. See ya. Wouldn't want to be ya. Okay, back to positions. Go to all, And that was Canopy Growth. We've looked at that one. Grow Generations. We looked at that one. Cronus. We looked at that one, right? Didn't we? Oh, no, that's another loser. 458 days. We could sit there and sell options against it, but let's go look and see if there's any options worth selling against. See, nobody's playing in it. Nobody's playing in the sandbox. Let's just exit out of that baby too. We're gone. See ya. Can't put any options against it, so there's no reason to hang on to it. Just take our lumps and walk away. All right, so that's what we got so far. Down $92, cleaned out a couple of losers, picked up a little bit of profit, and we still got our positions in here up $12,000. Still riding with the 12. Okay, that's good. We're not sad about that. Cut the losers short, let the winners run. Okay, anything else we want to look at? Yeah, we want to quickly go down through just a couple of these hot stocks that we got in this list, like Apple, because it's nice to look at the overall longer-term trends of some of these big players, all right? Because they kind of give you an idea of what the overall market direction is going to be just by looking at some of the big players. So we just want to look at some trends in here, and we can see that we got a nice little uptrend on Apple. They finally kicked into gear after months and months of doing nothing and dying. They finally started talking about doing something with AI, and so they kind of kicked that up right in there, and the market started to rally for them. But we're getting a little pullback in here. So this is drive one off of this takeoff here. So we got drive one, we got the counter trend, we got drive two. Maybe we'll get a little counter trend and another drive three. Who knows? We don't know, but that's kind of the odds, right? That's what we're looking at. We're looking to see if we can't get a third drive out of this thing. You could say this is our first drive right here, and we've already at the third drive because there's our low right there. So we got our coming downs here, we got our crossover here, and we started our new up. So this is drive one, this is our counter trend, this is drive two, counter trend, drive three. So that's a more conservative view of it. If we look at it from, saying, well, this thing was just in a narrow sideways channel here, and then it broke out, we can say, well, this is drive one, drive two, drive three. We won't know until it happens, right? But we're going to take the rest of the market into consideration before we start deciding if we want to start pouring money into this Apple market, right in here. We want to see a first green candle make a new high in here, but realize that that could be just a little, I got to draw it the other way. Could be a little triangle wedge pattern in here. So we'll watch for that, a little rally, little green bars, then back into some reds. And then it'll be that second little set of green bars right in there where we'll look for a rally. It could come all the way down here to the red, the red line, which would be the Fibonacci sweet spot of that entire move. If it did that, we'd be down in here. We'd look for it to at least hit 38.2 at this point. So 38.2 gives us a little bit more downside, but the Fibonacci sweet spot is right here. But if it just comes down, bounces off that 38.2, we might get the little triangle in here and then the rally out of that side. If we can get Apple to rally at all. We got a little rally coming into Apple. It's about frickin' time. Okay, let's go look at Adobe. Now, Adobe is something I'm really worried about. All right, how many of you have Adobe? How many of you have traded Adobe? How many of you have the Adobe products? I'm very concerned about Adobe because this is the one company that AI is going to kill more than anything else. A lot of people are going to say, I don't need Adobe anymore. Why? Because I've got AI, and AI can go and, if I want to, take a picture and there's somebody in the background, what was the way you used to do it? Well, you'd take it into Adobe's Photoshop and you would Photoshop it out, right? That was the term we used to always use on the internet. Oh, that image looks Photoshopped, right? So the software Photoshop comes from Adobe. Adobe is the company that manufactures makes the software program called Adobe, or called Photoshop. And so these guys are being painfully hurt by, you would think, are being painfully hurt by AI being able to come in and just pull up an AI, an artificial intelligence window and throw a picture in there or give it a prompt and say, I want a picture of, whatever. And it just gives you this picture and it creates it for you. And then you're like, oh, well, I don't want that person in the background. You can just tag it in the AI system, hit click, and it'll take the person out of the background. Or you can take a picture that you took on the beach, give it to AI and say, take that person out of the background. It'll just take it out. And you don't have to go in and do all this manual work and be a real skilled person at Adobe, at Photoshop. So I've been really worried about about Adobe, thinking, hey, this might be a great opportunity to take some short positions, right? Make money on the as the market falls and isn't going down. And so that was my thought process. I'm like, these guys are going to really be hurt by this. But there's always a but. When you come in here, oh my gosh, losing my voice again. ADBE. So we go into Adobe, and with that mindset, we start looking at how much money they're making, and it's like, oh my hell, that's not what's happening at all. But I have another but. I mean, look at this. This is the earnings per share. And in 2024, it was $12.36. See that? But what is it today? EPS, earnings per share. That's earnings per share trailing 12 months. See that? TTM, last 12 months, is 16.05. Now, I know that dips into last year, but still, earnings per share next year, this year is 12.85. And so earnings per share was last year, their peak was 12.36. 12.36. And this year it's 12.85. Well, it's 12.85 because the stock has come down. Their earnings, though, I mean, look at their sales. $21.53 billion in 2024, and their sales now are $23.18 billion. So they're actually got bigger sales for 2025, and we're not even done. And they got bigger earnings per share coming into 2025. Now, it's bigger earnings per share because the share price is flushed. I think a lot of people look at AI and have been thinking this, but Adobe's not hurting. In fact, maybe, just maybe, because they have a lot of AI features in their software. They grabbed right onto the bulldog and started putting AI features. So when you get Photoshop now, you go into Photoshop, you can do all kinds of AI stuff with it. So it's become an AI tool, very fancy AI tool. And their sales have actually gone up. Now, there is a caveat to this. There's two caveats to this Adobe stock. Look at this. First of all, the shares outstanding are going down. Now, I know they try to tell you that that's a good thing. Oh, we got so much cash. We're giving it back to you through your shares. Bullshit. Bullshit. The only reason you pull your stock back, your shares back, is because you're trying to prop up your share price. And they've been trying to prop up their share price clear back since 2016. That's not a good thing. You do not want to see them buying their shares back, because that makes the stock price go up. When the stock price goes up, well, you own the stock, so you're happy, so you don't sell it. That's the only reason they buy their shares back. You think they want to buy their shares back? Hell no. Why do you think they sold them in the first place? Because they didn't want them. They wanted the money that they got, right? The money they got from selling them. Now they don't want you to sell your shares because that'll cause the market to flush. So what do? They buy shares to prop up the share price, to keep the share price high so you won't sell. Why would you want to sell? Well, because their shares are tanking. Why are their shares tanking? I have no idea. Look at all these guys here. This is the other caveat. All these guys, Morgan Stanley, downgrade. Melius, downgrade. Rothschilds, downgrade. All these guys downgrading this stock when they've got outstanding sales and their earnings per share are huge, but they've been buying their shares back, which has been propping up their stock, propping it up. That's all that means. Now, it's good for you if you own it. It's propping it up. They're giving you some of the money, but they don't do that because they love their own stock. Hell no. They do it because they want to prop their stock up. They don't want you to sell. They don't want to have to spend their money on buying their own stock. They want to spend their money on growing their business. So why is Adobe flushing like a toilet? I don't know. It shouldn't be. It shouldn't be. It's participating in the AI run, and yet it's not. I mean, they've got great AI tools, and they're making money hand over fist, but their stock's dropping like a rock, and all the companies are downgrading them. You tell me. It makes no sense at all. Makes absolutely no sense. That's a hard one to understand. It's, in my opinion, this should be a great opportunity to buy into Adobe because they're making money like crazy. They're making money. They're going to have a 2025. This little blue bar is going to be up here big again. And if they, why are they buying their shares back? Well, they're propping their stock up for one, because it's flushing like a toilet. That's why they're buying them back. But they're making money. Look at their earnings per share. Well, if the earnings per, well, that's going to see, that's all falsehood too, because, well, they're making money. They're making money. You want to buy companies that are making money, and these guys are making money. Sales 23.18 billion so far this year, and that's more than they made last year. You can't complain about that in a year where AI is taking over and they're still making more money. I think people are using the AI, and then the people who use Adobe are like, hey, look at what we can do with a combination of both tools. So anyway, I'm just showing you that if there is a chance to get into Adobe, we should watch this baby, because man, this thing's, it's making money. This should be a good buy, and this market just keeps flushing. Let's look at a longer term. This is the weird thing. I mean, last time it was this low was clear back in 2020, October of 2022, 3 years ago. And this is all the AI push right here. And they're just, nobody's doing, I think everybody thinks that Adobe is not participating in the AI, and they are winning in this AI world. So I think this is a miscalculation on the market, and I think Adobe is a good buy. I don't know, we'll have to watch and see. We don't want to buy it right now. It's still flushing. We could put some positions on it. We go over to our trading platform and we could put some positions on it because it's still flushing. It might catch down in here. Let's see what we could do. See if there's anything we could make some money. I still got that damn 38 days. This is the only thing we got to play with here. If we sell some premium up here, what can we get out of this thing? If we put this way up here, $400, that's fine. Look, we could make $500. 8% return, clear up there. If we put it right at the $500 in, see, but it's 38 days. Clear out here. Do we think the market's going to turn and rally and come up here? No, the rest of the market's flushing right now. I think we could be easily safe doing this, and that'd make us $500 a piece. How much we have to put up for that? Well, that's a $6,000. It'd be an 8% return in 38 days. I mean, you can't get that at Cash Valley Bank. 8%, and what's the probability of us making that? 73%. It's at 73%. You could push it out there to 80%. It's where we often like to be, is 80%. That's $365 with an 80% chance of getting your money. It's a delta of 0.20. Implied volatility is low at 34, but it's going to give you $365 return on risk. It's a 6% return on your money of $5,000. It's a lot of money to put in, I know. It's because Adobe's share price are $375 a share. So it makes it hard for people to trade. You're putting up $5,000 to make $365 in 38 days. And you've only got an 80%. You got a 20% chance that you could lose your money. So it's 80% chance. If you went to Las Vegas and had a table game that you could play at 80%, you'd do it all day long. Right? So why wouldn't you do this? Well, I don't know, Lan. It's $5,000. Yeah, but it's 6.74% in 38 days. You're going to have to actually cover that. So it's going to have to, let's come out here. It's not going to be that much. It's not going to be that much. We're going to have to come out here and cover it. Even if we covered it low like this. Let's sell this one. Actually, sorry. Delete the, I screwed up. I got it. Okay, so we're going to come in here. We're going to sell this one. What did we say? 80%. 80% was right here. And then we got to buy this one, not sell it. So we got to buy one, even if we buy it in close. So we buy this one, it's going to significantly reduce our margin requirement and increase our risk. So that gives us we're going to receive $94, which you're like, well, that went down. Yeah, but it's a 9% return on your money because your margin went down to 1,000. So it's no longer a $5,000 margin. Can you see that? Am I in the way? No, you can see it. Delta's the last one in the column. We're okay. All right. So if we're looking at this, we're going to receive $94. Return on the risk is 9.4. So it actually went up. If we bring that in one more, you can see it's going to lower it even more. So now I have a return on risk of 10%. We're going to receive $50 and have a margin requirement of $500. So you're like, why wouldn't you just do that? Well, you can. You just raise that up to do 10 of them. All right. And now we're in here at $5,000 again to get our $500. All right. And that's a 10% return. Now, the thing is you could lose your $5,000 if the market touched the purple line above the red line. but you have no long position in here to help you cover the rally up. So you'd have to, if you wanted to think the market was going to rally to cover this, you'd have to have a long call in here. But I don't want to put a long call in here, not with the market flushing like this. Now, the implied volatility is going to be very low at 35. So if the market started to rally, it would have to, the problem is that would increase the implied volatility, which would take money away from us. You want to do it? It's 10%. Let's just go ahead and, we're going to have to wait almost 2 months for this thing to do this, but what else are you going to do with your $5,000? It's going to sit in your account unless you go put it somewhere else. But this is an opportunity if you want to play against Adobe. So we could come in here and all we do, let's just mark it into it and see if it'll let us have it. Got real low volume. Open interest is not bad. I don't think it'll let us have it. It just threw it away. Threw it out the window. Positions, chart. No, it didn't let us have it. Stupid demo account. I think in the real money account, that would have let us have it. We probably have to do a limit order in the demo account to make us let us have that. Of course, sometimes it's been really slow. And then like 10 minutes later, it'll show up in there. So I don't know. The demo account's weird sometimes. This is just a demo account. So if you want to do it in the real money account, it's going to play it. You $125 on the spread. Maybe we're happy we didn't get it. Ugh. Well, the spread up here is not so bad. I don't know. It didn't go through, so we're not going to waste any more time on it. But that's the argument with Adobe. Amazon. Look at this. 1, 2, 3. Ugly 3-drive pattern. Ugly 3-drive pattern. But we're up here at the top. We broke a double top. So we got a double top up in here. But it did break it, and then it failed. So now we're in the retracement period. So we're going to come in here. We're going to go like this. Well, that's really not going to give us much. That's not much help, is it? It's going to be more like this. How are we going to draw that in there? What tool can we use? I'm just going to use this one. I think it's going to come up here. It's made this move here. I think we're going to, well, we might be catching right down in here. Let's see. Let's draw our Fibonacci ruler. Well, we got our Fibonacci ruler. Let's go from top to bottom all the way. I think, well, the whole market's in a flush zone, right? So I think we got more downside potential on this thing. I think we're going to see this thing down in here. I think we got our A, B, C, D, just like that. A, B, C, D. This is our little A, B, C, D pattern. That's the tool right there. A, B, C, D. Let's go ahead and clear out everything. Clear out everything. Start over. Come on, land. 1, 2, 3. So that puts us in the Fibonacci sweet spot right there. That whole thing right there. And you got your projections 90 to 100 at 38.2. So when Amazon hits this level here, we could start putting money into Amazon. All right. It's getting back into the region where we want to be buyers right in here. But we got to give it some time. Let it flush a little bit more. Markets are going to flush. That's what they do. Okay, Boeing. Boeing's got the same thing going here. We got drive 1, we got drive 2, drive 3, just as clean as can be. But the thing is, on this one, is it didn't break. That third drive didn't break the previous high. We had one little spiky dikey do right there, which was a Wyckoff spring, in my opinion. In my opinion. Okay, come on. There we go. So that's our little horizontal top line there. That market came in with a nice little wedge pattern and flushed out the bottom, and we're in the ABC pattern. So this is A, B, C, and it's really lazy on the way down, which is good. We're glad it's not just flushing like a toilet. It's coming down lazy. So that's good. Come on, stop that. All right. Okay, so here we go. A, B, C, D. Let's get a full view in here with our Fibonacci ruler. We're going to do the same thing and see where we think that market's going to go. I'm going to peel off that spiky dikey do up there. And I think we're going to come in here. Here's our Fibonacci sweet spot. There's 38.2 right there at 90 to 100% projection from where we're at. So right in here, we could start being buyers. All right. So if you got some money and you want to put a little money into Boeing, this is where you want to be a buyer, right in here. Okay. So that means there is some downside potential here if we wanted to. Now, this is, again, it's a $200 stock. So if you're going to come in here and start looking at selling options premium against it to pick up a little bit on this, on the next leg down, the A, B, C down, I think we're going to get it down here. So we could sell some up in here, but let's see. Spreads are okay. We're not crying about the spreads. The volume is this one here is the one that everybody's playing right here. So that's the one everybody's playing with. Receive $540 against that one. Now, if you do that, you've got to wait a second. 38 days. How come that switched on me? Okay, we're going to come in here. We'll just do one here. We'll just buy this one as protection. That would give us, we'd receive $223. That'd be 22% return on our money with a $1,000 margin. Now, we could push it out a little bit, but there's really, I don't know why you would. 13, well, we might want to push it out one more. But that would lower your, see, that would return on risk would go down to 200. You receive $300. Margin requirement would be 1,500. So you're putting up more, but you're getting your margin requirement, but it's 20%. Your margin requirement is 1,500. You're going to receive 300. So by putting that closer, you're actually risking less money. So now your margin requirement goes down to 1,000, and your return on your risk is 2230, and you're going to receive 23. So each time you pull that closer, see, it's better insurance. So your margin requirement is less, so your return on risk goes up, but you receive less money. So you have to do higher quantity. So you're going to do a higher quantity to get your to receive more money. Now it's more dollars, 25% return. So if you want to do something like that, you could do that just as an entry. Just like, I'm not really comfortable, Lan, or familiar with these. That you could do that one right there, and that would give you a little bit of experience. So you'd be margin requirement 500. They're going to margin you at your max loss. So the most money you could lose is $500. The return on, and you're like, what? $500? I don't want to lose $500. I'm saying it's your max loss, $500. Return on risk is 25% return. That's a good return. You can't get that at Cash Valley Bank in 38 days, right? If you take, let's just say that if it was 30 days, let's do a 30-day annualized return. So take our little calculator, and we'd take that 30, let's just say 38%, no, 25%. 25% times 12, it's a 300% return on your money annualized. That's not bad return, 300%. Can't get that at Cash Valley Bank. Of course, you have a risk here of losing your $500 if that market goes above the red line by the purple line. It's got to hit the purple line underneath the red line. That's all we're saying here. And I think it's going to come down. I think we got more downside potential. I think we're going to see it down in here. Might not, might turn around and start to go right back up immediately. Don't know why it would, but it could. Most of the rest of the market's in a downtrend, so I think we'll continue our downtrend. We're going to come back down into this region here. So we could go ahead and put that on. Or we could do 5 of them just to keep it light and simple, right? So that's a $2,500 investment. Max money you're going to lose is $2,500, but you're going to make $600, 24% return if this market just stays below that red line for the next 38 days. That's the game you're playing, all right? So we're going to, let's use limit order because the so we're going to sell one, buy one. I think we have to go down. Oh, gee, many Christmas. Look at the spread on this. That gets really ugly. That's $50 spread. Maybe we don't want to do this because we're going to have to realize that entire spread. Now, if you're in the real money account, you can bid for it and not have to pay that wide spread. But in the demo account, they make you pay the entire spread. And here the spread is so wide. Look, it's all the way down to 80. There's no way we're going to be able to do this. That's a $400 spread. That takes us down to 400. That's a 16% return. $400 spread on 5 of these things. That's $100 a piece. 50, 60, 70, $80 a piece. Yep, that's what it is. I don't want to do that. I don't want to do that. Receive $400, all we get out of this thing. We're going to risk $2,500 to get $400. And our probabilities are only 66%. But we got technical analysis saying this thing's going to flush. Our TA says that the market's going to flush some more. Spread $400. Can't do that. I can't do it. I can't do it. Receive 400, 16% return on a $2,500 investment. Risk 2,500 to make 400 with a 66% chance of being right. When technical analysis saying this thing's going to flush down here. Okay, well, we put it on. We put it on. I don't know if I'm happy about that. Look, we're down $200 right out of the gate. That's our spread. That makes me butt pucker. Caterpillar, look at this baby rock and roll. We already looked at that one. It's a nice 3-drive pattern. Drive 1, there's drive 2, there's drive 3. So we're coming up into the drive 3. Where are we at on the drive 3 land? Look at this perfect little triangle right straight out of the manual. Right across there. Little pennant formation. So we came down, made the red bars, made the first set of green bars, next little set of red bars, and boom, the thing took off. So that's that perfect little pattern. What little pattern, Land? I don't know what you're talking about, little pattern. Little pattern, little pattern. Where'd the little pattern come from? Right here, slides. Where's our little pattern? Oh, hey, while we're here, Elon Musk says making an extra 10,000 is easier than trying to save 10,000. The sooner you understand that, the sooner your life will improve. All right. Here's the little pattern I'm talking about right here. I show this to you guys every once in a while. So where is it? It's right in here, right in here, right in here, right there. See that? So you go up, the red, the green, the red, take off. So up, red, green, red, take off. So that's what we just saw right there. Okay, so we come over here, up, red, green, red, take off. Watch for those. Those are good patterns. We generally see them right between the drives, all right? So that's how you know market's moving from one drive to the other. Look, I did it here too. Perfect, just like out of the book. So we went up, red, green, red, boom, take off. Up, red, green, red, boom, take off. Okay, so that's where you look for those, is in between these big long drives. That's how you read those charts, all right? All right, so we're in the 3-drive pattern, so that means it's peaking out. Auto scale, you auto scale. Okay, so now, 1, 2, 3. Let's see where this thing says we're at. I don't really know. It says we're at the 100% projection. Wow, look at that. We're right there right now, 100%. So I think that we're going to not see much more of a rally on Caterpillar. Doesn't mean it can't. Doesn't mean it can't go to 130.9, 161.8. Certainly can. But this big, huge, long drive right here is the same size as this drive right here. They don't look the same, I know, but they are. We just measured them. 100% is that drive right there. From A to B is the exact difference, is the exact same length from C to 100. It's right there. That's the same distance. So do you think it's going to continue rallying higher? Probably not. Let's see how far that first drive go. See, usually it was quite a bit shorter, wasn't it? So this was 100 here, and it dove down in here. But that's where we're at. We're measuring that baby right to the penny. I guess I got it back from this one. Right to the penny. We're right at 100. So I'm going to expect this market. This is the top. I think this is the top. Right up in here somewhere, we're going to get a little pullback. And then it might do it might do this. Look at this. Hold on. Hold your horses. It might do this. Okay. So this is going to be the top of that third drive. See, drive 1, this is a triangle. Drive 2, this is the triangle we just showed you. Drive 3. So that's where we're at right now. We're right here right now. So we're going to expect a little bit of this happening. We might get the spring, right, which is a little pullback, and then boom, another little pop, make you think it's going to go higher, only that's when it flushes and comes back down and starts coming back down. All right, so A, B, C, D. So this is your A, B, C, D coming back down into this part here where we catch and start to go back up. That's what we've been looking at. All right. So that's just our model. Why does that model work? If you can draw it out like that, aren't markets crazy and random? Why in the heck would it follow your model like that? You drew that out 10 years ago. I drew that out 10 years ago because that's what markets do. All right. And I haven't changed it because the markets over the past 10 years have done that just consistently. The reason this works is because the big quant systems, the big computerized systems that trade, BlackRock, Vanguard, State Street, this is how they trade. This is their model. All right. This is what they programmed in. How do you know that, Lan? Because I went to school with the boys who did that in Chicago at the Board of Trade. When I was back there, I spent 10 years at the Chicago Board of Trade during that time for it paid, going to all these courses and classes while I was tech support back there, basically teaching people how to trade using computers. And I went to school with those boys, and then they went to New York and created these patterns. I went out here, created my own software and with the same patterns, and I put all my stuff, all my tools that I learned at the Chicago Board of Trade into my software. They put all the tools that they learned in that at the Board of Trade in their software, and that's what they trade out there in New York. All right. So that's why that pattern works, is because that's what we were taught at the Chicago Board of Trade, how to trade. And so I put it into my software, they put it into their software, and that's how we trade. That's why it works. All right. It's self-fulfilling prophecy. We make it do it. All right. So that's your 3-drive pattern. Now we're going to come through and we're going to do this little jiggy joggy dance up in here. Does it mean it has to do it? No, because there's other factors in the market. I mean, not just us guys who went to the Chicago Board of Trade and learned how to trade. There's other people who trade too, and they trade different strategies. And that's why sometimes our patterns get broken up, because they come in and screw it up with their little patterns. So everybody's, and then there's retail traders who don't have any patterns. They're just dumb. And so they come in and they screw everything up too. But that's why we come in and we take the retail traders' money using this pattern right here, using this strategy. So that's the whole nature of the beast. That's how it works. All right. If you think the markets are not manipulated, I got a bridge over troubled waters to sell you, right? So this is the whole pattern. This is all done by computers, right? And that's why it works. So now we're anticipating that the computers are going to start to sell off up in here, and they're going to take this market sideways. We might get the spring, and then I think they'll dump it, a little ABC pattern coming back down in here, so that they can buy more, because they buy down here. They buy low. They do what they call accumulation. So they accumulate all down in here, which is why this indicator is green, right? This is when all the big boys are buying. And then they start to sell out. They sell all through here. Okay, so they sell. Who's buying? Retail traders. We are. We're buying. I'm not going to go into the whole big upside down pyramid conversation right now, because most of you have heard it. But we build big upside down pyramids. They build normal size pyramids. Once they get up here, they don't have any shares left. And so they can't participate in the market continuing to rise. So they pull their support out. And when the great big boys like BlackRock, Vanguard, and State Street, and all the other great big hedge funds start pulling their support out of the rising market because they don't have any shares left, well, the market flushes. So that's why this pattern works, right? They're out of money. They're out of shares. They buy low, sell high. And so because they're selling high, well, they don't have any shares left. So the market flushes, comes back down. They start buying low again. Okay. And then that's what causes the accumulation zone right in here at roughly, we figure, about the 50% level. So that's why we have these little red lines and green, yellow lines in here so we can see. But the Fibonacci tells you where that's at. So we draw that in there. And so we know where that Fibonacci sweet spot is, that zone where they like to drop the market back down in here. So they like to bring it back down in here. Boom, 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 boom. As it comes down, it'll come down in here. And then they'll start to accumulate once again in this little indicator that tells you when they're accumulating. See, they accumulated a little bit more right in here. That's called a reaccumulation right in there. And then they run the market back up and they sell out all their shares all the way up here. They don't have any shares left. They're out. And so now they're going to start dropping the market. It's going to come back down. The red is going to come back down. It'll cross over into green right down in here. And when it crosses over into green right down in here, they'll start accumulating and starting to buy up again. And that's how they get all their shares so that they can sell them out on the way back up next time. And then that's where we buy in, because we're like, oh, we like to buy rising markets. So we'll start to buy in small retailers and ride that thing back up. All right. So we'll sit through this whole thing, lose all of our money. And that's what we like to do. Oh, I'm going to hang on. I'm going to hang on. I'm going to hang on. And then you'll come down, and you'll hang on. And then finally you'll sell it, and you'll sell it to them down here. And then they'll take the market and go back up with your shares. That's how it's done. Okay. So just Learn that. That's the pattern. That's the strategy. That's how it works. So as long as you know that that's how it works, you can play against it. Okay, let's come down here to Salesforce. Salesforce. Why is Salesforce struggling like Adobe? Look at this market. It's flushing like a toilet. Straight down. We gotta go look at this. This is another favorite stock. Why would it be tanking like a, why would it be flushing out like a toilet? Let's come in here and look. We got to come over here. Our trading platform doesn't have all this fundamental information. So let's come in here and let's look at CRM, Salesforce. And we want to see what their Salesforce announces a $15 billion investment to support AI innovation and deepen strategic partnerships with OpenAI and Anthropic, launching new AI-powered Agentforce platforms and collaborations with Stripe on agentic commerce protocols. Today at 9:10, Salesforce announced a $15 billion investment to support AI innovation. Well, I didn't see their stock jump. The thing is, look at this. Look at this. It's the same as Adobe. I mean, this is not, the greatest back in here, but look, 2024, they made 6.36 sales in billions going up. What's their sales this year? Sales 39.50. 39.50, and the year's not even over. 37.9 is what they did last year. It's going to be another big up bar. These guys are making money hand over fist. What's earnings per share? Trailing 12 months is 6.89. That's higher than it was last year at 6.38. The year's not over. Well, that's trailing 12 months. This year, earnings per share. Next year, this year, 11.5. Well, that's because their stock went down, right? And look, they were putting shares, they were selling shares. That's good. And then they started buying them back. They were positive. They were like feeling really bullish here. Then they started feeling, shit's happening. Look, all the downgrades. Look at all the downgrades. These guys are making money. They're making money, people. Look. Sales, $39.5 billion. And the year's not even over. We're mid-October, November. They said we still got 2 months left. And they only made They only made $37.9 billion last year. This year, they're at $39.5 billion. Earnings per share, 6.36. Earnings per share currently sitting this year, 11.58. And they're buying their shares back. And they still can't keep it up. Man, they got a bad case of. What are we going to do? What are we going to do? This is a accumulation if I ever saw it. Accumulation. Okay, so this is our 3-drive pattern. Let's come back over to our platform. Wait, was that the same stock? It was. What's the difference? How come this stock is, that's weekly. I'm looking at a weekly chart. We got to go to the daily. Okay. There's no real solid pattern. I think we're just going through, look at this. Let's go look. We're just going through an accumulation stage. They're popping. Look at that. They're buying like crazy. I think the big boys are buying this stuff up. CRM. Does YieldMax have a Salesforce? Let's go look at our calculator. Pit News Magazine. Does Salesforce, do we have a CRM in here? I wish I got it. We got to get this thing to sort. Got it. Sort for me. Hit the set header sorter. CRM. Is there a CRM in the underlying? CRM. AMD, MSN, CRM, CV, CRM. This list doesn't sort, sorry. CRM. Any CRMs in here? CRM. No. Damn. Load it up on that baby. CRM. They don't do it. They don't trade Salesforce. Oh. I think this is an opportunity. These guys are making money. And this market is flushed down. Now they just got that notice that says they're getting heavy into AI. Why is nobody buying this? We know what they do. They got a database of salespeople who call people and make money, right? I mean, Salesforce, it's a salesman's database. Maybe they think AI is going to take over and do all that stuff. Well, no, you still have to have a database of your customers and clients. AI could take that over. Maybe they think these guys are going to get wiped out by AI. But they're getting into the AI. They're going to integrate AI into their system. I don't know. This just seems like too good of an opportunity. They're good company. Let's come in here and let's go out 100. Let's just go till the end of the year or end of next year. Let's go out January 430. Let's go look and see what this volume is here. Oh, look, lots of people buying this one. 430. That was 12. Let's go out to January. Oh, see, people are looking at this stuff. 2020. This one's even higher. More volume. Let's go to this one. Not as much. That's the play right there. Okay, let's buy one of these. There's 2 of these been up. 14 of those have been bought right there. I think that's their covered. No, that's not covered. Nobody'd cover that. Let's do this one here. Let's see. If we buy that, that's $4,000. I like it a little bit in. Can we do that one? I like that one better. Oh, look at the spread. 300. No wonders they're doing that one. 2 of them. 4,200. Spread of $185. If you put that on there, you could sell calls against this thing all the way for the entire next year and a half, year and a quarter. Because this is $275. So if you wanted to put a call against that thing, you could sell one way the dickens out here. Go all the way out to 80. Just to see, just for fun. What happened if we sold one there? $727 to sell that call? 80% probability. What the heck? Oh my gosh. Oh, that's 430 days. I don't want that. Edit mode. I don't want that. Let's delete it over here. Let's clear that one out. Just the buy. I think let's come down here and do the 38 and we sell. It's $200. One, we're not covered. We have to do a separate setup for that one. But you're going to receive $304. I don't know. I don't know about that. But we could do this, just this really long call. We could put this thing, I think they're going through accumulation. I think drive 1, counter trend, drive 2, counter trend, drive 3. 1, 2, 3. I think it's there. It's a big investment. And it's a long-term payoff. And the implied volatility right now is really, well, it's not low, but it's not high either. It's 42%. It's a pretty quiet day. We should buy this probably at noon today or more. I don't know. We'd have to look and see. This, I want some Salesforce. This looks really good to me. Let's come in here and look at a 2-minute chart, see what the market's been doing today. Well, it flushed some more. on the news that they were going to go into an investment with OpenAI, their stock flushed. How? We're coming into, I don't know. That's why we call it speculation, right? Nobody knows. Okay. Let's come back out to our daily chart. And let's put that on again. Let's go back down here when we decide 430. And we wanted to buy this one here. It's $180. Pay $4,270. Limit 4180, 4360. Ooh. 43. Come on. 60. 4360. 180. There it is. All right, let's see if they'll give it to us. They did. All right, we got it. We own it. Bought Misty near 18. Rock. Had to sell at 14. Instead, bought 2 TSYY at 768. Wasn't comfortable with Mr. You got to be careful with that, Rock, jumping in and out of those markets because they're designed to go down, remember? I mean, we like them to go up, but Bitcoin has been going down, so the market's going to go down. Remember, I'm going to pull this up in just a minute when we get over to our portfolio because I'm going to show you what you're playing with, all right? You're focused on the wrong thing. You're focused on the wrong thing. Not that it's bad. I mean, it's not that it's the wrong thing. It's just the least important thing. You're focused on the least important thing or a less important thing. Not the least important thing, but the less important thing. So let me take you over and we're going to show you that, all right? Let's run through just a couple more of these real quick. On Google, there's Google. Google's 3-drive pattern. Drive 1, drive 2, drive 3. I think we're up here. We're going to get an ABC on Google. Johnson & Johnson. Drive 1, drive 2. Ooh. Drive 1, drive. I don't want to call that a little drive by itself. That's one great big drive. But we're getting a little ABC top formation in here too. So that's your ABC top. Where are we at? Johnson & Johnson. We got a little bit more downside to go. I think we're going to get another leg down on Johnson & Johnson down to into this region here before we want to start buying. But there's no Yield Max doesn't trade Johnson & Johnson, so you have to trade it on your own. Microsoft, same thing. We're getting that pullback into the Fibonacci sweet spot. Everybody's freaking out. This is just par for the course. We got a spiky dikey do right there. This is just par for the course stuff. Everybody was expecting this, right? We in this class, we knew this was going to happen. So we're anticipating. We got a little bit further down to go. Microsoft going to pop here, come down probably around into this region here somewhere. It's going to break that low right there for sure. We know that. It'll break that, come down in here, and this is probably where they'll start doing an accumulation. Watch for the green bars. Watch for those to happen right over here. And that'll probably be the first accumulation. We may go into a second accumulation out in here. Who knows? All right. So the Netflix just got Elon Musk. So he told everybody to bail out of that thing. So I don't think we're going to get any big rallies out of this thing. So if we wanted to, we'd come in and sell some premium up in here. I'm not going to do it right now. They're $1,000, $1,300 a share. That would be a big deal. All right, NVIDIA, same thing. NVIDIA doesn't flush like other markets, but you never know. 1, 2, I don't want to call that 3 drives. It's 2 big drives right there, and then we got the top. It just kind of never really broke because it's NVIDIA. And so it's gone sideways here. We're getting, that's the Wyckoff spring, I think, right in here. And I think we're going to now get a flush back out. I think we're going to get a flush on it. That's good. We can get some more NVIDIA. We want more NVIDIA. We want to buy more NVIDIA. I'm going to put that right here. This is this Wyckoff spring. Popped everybody, got them excited so they could take their money. I think that we're going to get a drop right here. I think we're going to get an ABC pattern in here. Because look, the big boys want some. See, they put a little bit of accumulation in there. They ran it up just to get it to go so they take everybody's money. Now they're going to flush it like a toilet. Okay, that's what I would do. That's what I would do. That's what I learned. That's what I was taught. That's how I do it. So if I was in New York running the same pattern, I'd run it right now. That's what I would do. I'd bring it down here, and I'd bring it down all the way down into this region here. This is where I'd start being a buyer. Now, it doesn't mean you can't go a little further. You certainly can, but this is where I'd start being a buyer, and you should watch this. This will be green out in here. When this goes green out in here, this is, watch for that green. That's where they're going to start buying again. Again, it's this pattern right here. This pattern right here. Okay, that's where we're at. Right now, we're right in here. We're doing this thing. Right up in here, this is this. This can be longer, shorter. This is just how I drew it, all right? Okay, Palantir. Same thing. Palantir. This is a crazy market. 1, 2, 3, A, B, C. I think we're going to get a little pullback. Probably at least, well, I'd like to see it down here, test these lows down in here. I got so much money I want to put into Palantir. I got money sitting on the sidelines, and I would like to put it into Palantir. PLTY, actually, not PLTR, but we don't look at PLTY as the trading market, right? Same thing with you, Rock. I'm going to talk to you about that too. If you're looking at MST, MSTR, MSTY, I feel more comfortable with Tesla. Yeah, you may. I like Tesla too. Tesla's got they're getting ready to come out with a new version of their software. They haven't come out with a new version of their software in almost a year, over a year, and they're coming out with a new version of their self-driving software. And apparently, it's amazing. I bought me a little Tesla. I have one, and I have the old version of the software, and it's still amazing. But now they say the new version that I haven't received yet. I've been watching some guys on YouTube who have received it, the early adopters, and they say it's amazing. It drives you everywhere. You never have to touch the steering wheel. All right. I mean, the one I've got drives you almost everywhere. You never have to touch the steering wheel. But, you know, you get to the end, you still have to park it and stuff. And it does self-parking. You drive it in the parking lot, you push a button, and it parks it for you. But this new version just drives you from parking lot to parking lot, parks for you, drives around, it takes you drops you off at the front of the store, goes and parks itself, comes, it does everything just like a taxi would. All right. So apparently it's pretty cool. Okay. So this is what I expect. I'd like to see Palantir come back down here so I could buy some more. That's why. PayPal. We don't have to talk about PayPal. We talked about that when we talked about UNH. All right. We're done. So that's where we're at. So now we're going to go over and look at our portfolio. And I'm going to start with Rock's comment right here, because Rock talked about Misty and also talked about Tesla. So we're going to start with those two. Misty, I'm not saying you were bad to get out. It's just that the piece of shit's been going straight down. And I'm in it. I got it. I got some. I got in like right in here is my average price. So my average cost is like right in here. And I picked up a bunch more and a bunch more as it came down in here, and I pulled my average price down. So that's where I'm at. I'm kind of sitting like right in here with my average cost. So I'm underwater, right? Well, that's what you'd say. You say, oh, Lane, you're losing money. You're losing money. The market just keeps going down. And it does. So the thing is, I'm not real thrilled about MSTY because it's going down, but you don't look at MSTY. When you're trading MSTY, you look at MSTR, which is what Rock's saying, right? So we go look at MSTR. MSTR is the market you watch when you're trading MSTY, not MSTR. Don't ever look at the yield max version of the stock to decide whether you want to get in or not. You look at the underlying. So when you come over here, you don't ever look at this symbol to decide whether you want to get into it or not. You look at this symbol. All right. This is the symbol you look at to decide entry and exit based on our technical analysis strategies. So we want to look at MSTR. Now, where's MSTR? Now, this is Bitcoin, and primarily, I mean, we generally look at MSTR MicroStrategies as a Bitcoin because they have so much Bitcoin on their books. They're actually a technology company. They're a software firm. But they have so much Bitcoin on their balance sheet that their stock actually acts as if it's Bitcoin. Now you've also got BITO, which is the ETF, and you'll notice they look almost identical, right? So this is BITO, and they also not doing very well. Everyone's expecting Bitcoin to go. If Donald Trump would do what he says he's going to do, and you listen to those guys on his inside his inner circle, they're buying Bitcoin like crazy. Every time it dips, they buy more. It's what's his name? The one who was in New York in the top of the towers on 9/11 and lost half his company. What was his name? You guys all know who I'm talking about. Name slipped my mind right now. Anyway, he's always saying how he's buying Bitcoin. He's getting into Bitcoin. So this is BITO. This is Bitcoin. Bitcoin's just been going sideways, not doing anything for the last year and a half. Done nothing. But it kicks out such good dividends that, even when you got MSTR, which is not doing anything either, but it's been going down pretty nasty. Nice little 3-drive pattern in here from that peak. Drive 1, drive 2, drive 3. We were all feeling really happy and thinking that we were going to get a third drive out of this thing here, thinking we're going to go up and break these highs, and then of course it flushed and failed on us. But it's still right here. It's still within play. It's not like it's not like it's clear down here in the toilet. I mean, we still got some areas of support in here that we could come down to. Right? I don't want to see it come down here, but that's probably where it's going to go, down in here. But we are getting some accumulation in here. See this? Real heavy accumulation. So there's buyers buying in here. The big boys starting to load up a little bit. Now, I want to take you over and show you the calculator. And I'm going to show you, Rock, while you're looking not at the wrong thing. It's not the wrong thing, just the less important thing. So we're going to come over here. We're going to go to the calculator. Now, this is my portfolio, all right? And this is portfolio matrix. And this is real money in here. And we're going to come into the, I want to come into the individual stock. Oh, right here. So I'm going to, what did I do? Let's go back to here. Okay. So I'm going to come here and we're going to put in MSTY. All right, not MSTR, because MSTR is not the one we're trading. This is where we're going to put our money, MSTY. So we pull up MSTY, and you'll see that you're like, well, I got in and it dropped $2, and I didn't want to keep it, so I lost $2, right? But the $2 is the gain over the last year. It's lost 51%. So that's what you're talking about. You're saying, well, I bought it at 18, it went down to 14, so I lost money. Well, not necessarily, because you're just looking at the gain. And remember, when we look at the yield max funds, gain is secondary. It's not primary. If you look at a normal stock, like what we've just come from, where we've been looking at Apple and Amazon and Netflix and Caterpillar and all those, yes, gain is our primary focus. But when we move into this other world, it's like you have to walk out the front door of gain, close the door behind you, and go across the street and into another place where we're going to go into the yield room, into the yield building. All right. So we left the gain building behind. We're going to go into the yield building, because these markets don't make money off of gain. They make money off of yield. So if you're focused on the gain and you're looking at these markets, you left the gain market behind. You're now in the yield world. You're looking at the wrong thing. Not that it's the wrong thing, because it's not that it's not important, but it's not the thing that makes you money. All right. Gain is not what makes you money when you're looking at the yield max funds. So this market is down 51%. So you can say, Lan, you're down 51% on your money. Yes, but I received a yield of 113%. I went out of the gain world and I went into the yield world. So if I lose some on the gain, I'm making it up in the yield, because I'm making 113 in yield. So overall, at the end of the year, I made 61% return on my money. Did I lose money? No. My gain went down 51%. Why? Because the piece of shit didn't go up. It went down. But this is the gain. This does not show you the yield. If you want to see the yield, you have to come into a calculator that shows you the yield. And I don't care what brokerage firm you have, they don't show you this chart right here. So this is the profit right here. This is the yield right here. See the little purple line? This is the gain. So if you're focused on the gain, oh, the gain's going down, I don't want this market. This piece of shit market. Who wants to trade that? Who wants to have that? Nobody wants that. It's down 51%. I look at my little phone. Oh, I'm down 51%. No, you're not. Because you showed 113% yield, which they don't show you. This does not show you 113% gain. There's no 113% gain in there. Where does it show you that? Doesn't show you that. Nowhere. It shows it to you over here in a special little calculator, a program called Portfolio Matrix. You have to have some other program that shows you that. And now you can see, yeah, I lost 51%. So you went from 18 to 14, but you didn't anywhere in there, in your little note right there, Rock, show me how much you made in yield. What was your yield? Because your yield is what's important when you're trading these markets, all right? It went from 50, you lost 51% on the gain, but you made 113% on the yield. So overall, you made 61% return. That's a lot of money. 61% return? That's a lot of money. Okay. So let's go do that with Tesla. So we're going to go look at TSLY, TSLY. Now, did you say Tesla? Oh, you went to TSYY. TSYY. Now, TSYY is the Granite Shares Yield Boost version, which does options. All right. So you're going to have the same situation here, Rock. You're going to have the exact same situation where you're going to gain, or you're going to lose, in this case, 68%. Now, that's including this great big huge drop here. And the market, admittedly so, has, ever since they started to go to weekly options or weekly payouts, has stabilized a little bit, but it's still going down. So you're going to lose 68%. You're going to make 100%, so you're going to make 35%. So by moving out of Misty, which was making you 66% because you lost some money, you moved into TSYY to something that's only going to make you 35%. So you left something that was making you 66% for something that's making you 35% because you lost money on the gain. So you went to something that's going to give you less income. Now, not necessarily. And I make that caveat. The reason I'm saying that is you need to be mindful of both so you don't make that mistake. But now you probably didn't make that mistake, Rock. I'm going to take that back because this loss of 68% includes this great big huge chunk here while they were doing monthly distributions. Once they went to weekly distributions, they didn't drop like that. So we can go back to 6 months and drop that chart off, and you can see here now went up to 44%, 40%. So over the last 6 months, if we take off that big chunk that fell, they're down 35%. They're up 76% for a 40%. But yet you still went. You still went from something that was making 66% to something that's now making 40%. And you did that because the gain was losing money on you. And you're like, I don't like losing that gain. Well, you went to something that's not making as much money, something that was making more money, to something that's making much less money. So by moving out of Misty and into TSYY, you went to something that was making 66% to something that's now making 40%. That's you got to look at both. That's all I'm saying. Okay. Was it the wrong thing to do? No, I don't think it's the wrong thing to do. It was just different. It was just a different thing to do. All right. I've decided in the markets, there's not anything right and wrong. There's no right and wrong. They're just different. All right. You can always look in hindsight and say, well, if I would have done this, I'd have made more money. Okay, well, that was something different. You never know what's going to happen in the future. So stop saying things are right and wrong in the stock market. You didn't do right and wrong things. You did different things. I did something different, so I got a different result. If I'd have done something different than I did, I might have got a better result, but it's not wrong and right. It's different result. Well, I lost money. Well, that's not wrong. It's just a different result. It's not the result you wanted, but it's the different result. If I'd have done something different, you got a different result. All right. So these are all just different results. I hate to say wrong and right in the stock market because nobody knows anything about the stock market. Everything's a guess. That's why we call it speculation. All right. We're all just guessing. But and all we've got is past performance. Past performance is not necessarily indicative of future results, right? But it's the best we got. So we can only go off past performance. We don't know what it's going to do in the future, but this is what it's done in the past. All right. Wait till TSLA robots come out. TSLA go through the moon. Let's go look at TSLY because we were looking at TSYY. Let's go TSLY. And this is the yield max version of Tesla. And so the gain on that over the last year through this whole big push here, so we're down 25%, but the yield is 84%. So we're making an overall 58%. Making 58%. Now, I have to put a caveat in here too, because you have to realize that the gain is only a paper gain. You're losing 25%, but you're only losing 25% in the market. You haven't realized it until you sell your share. So Rock, you didn't realize that loss. We're going to use Rock as his example since he threw it out there for the public to see. You didn't realize, wait, it was the earlier one. No, here it is. You didn't realize the loss in Misty until you sold Misty. Now you saw a loss. You were looking at your phone, right? And you were like, oh, I've lost $2, $4. I've lost $4. Land can't camp. And so you're looking at your phone, you're like, Land, I lost $4. But you didn't really lose that $4 until you sold it, right? And in the meantime, you got a $700 dividend. Now that you realized the $700 dividend, because the dividend is the profit coming out. That's why the market fell, because they were taking profits out of the market and giving them to you and putting it into your pocket. That's partially why that market fell. So you're seeing that as a loss, when in reality it wasn't. They were taking the money out and giving it to you. That's why the market fell. All right. So you got to think about it like that. So you're looking at your phone, you're saying, I'm down $4. Oh, but you discounted the fact they gave you $700. If you did the math, it'd probably be very similar, very close to that. So you say, okay, I've got $700 in my pocket, but I've got a loss on the books. Now the $700 is probably bigger than the loss, right? So you don't know, but you realize the $700 profit. You realize that you can go spend it. You can go buy with $700 dividend. You can go buy a Tesla. My Tesla payments are $500 a month. I'm leasing it. I got a lease on a Tesla. Why? 2025 brand spanking new car. I think it had like 300 miles on it when I bought it. 100 miles on it. They were using it as a test car, so I bought it. But it had 100 miles on it, and I got it for $500 a month. So with your $700 dividend, you could buy yourself a Tesla, and you would realize it, and you could go drive a Tesla around. But Lan, I lost this much in the market. No, not until you sell it. Not until you realize it. And if you never realize, you know when I'm going to realize my drawdown? After I die. I'm not going to realize it till after I die. Why would I ever realize my loss if I don't have to? I'm never going to realize my loss until after I die. I'll realize it after I die. And in the meantime, I'm just going to keep realizing my gains. I'll realize my gains until I die. And then after I die, I will realize all my losses. How about that? Sounds pretty good, right? What if your wife wants to live off that? Okay, well then she doesn't have to realize any of the losses until she dies. All right, she'll probably live an extra couple of years longer than me. So now she can just sit there and realize all the profits, don't realize any of the losses, don't sell them. And then when she dies, my boys can realize all the losses. And then whatever's left, they can have. And they don't care about the loss. They're just going to be happy there's some money in there. Oh, look, Dad's still got a little bit of money left in his account. I think I'll take that. So you just realize all the gains till you die, and then let them realize the losses. Sounds like a pretty good deal to me. You don't have to realize the losses until you want to. Now, at the end of the year, you might have made so much money you want to realize some losses. But for tax purposes, you can only realize $3,000 a year. You've lost $50,000. You can only realize, so sell enough that you can show a realized loss of $3,000 against your taxes. You get the max tax break. That's called tax loss harvesting, right? And don't realize the rest. Just leave it in there as a loss. Who cares? You've taken the money out as a profit. You're going to have to pay taxes on it. So save some of that, right? Spend $500 of your $700 on buying a new Tesla. Save the other $200 so Uncle Sam can send it off to buy whatever bombs he wants to buy. All right. Okay, so that's how it works. So Tesla has a gain right here. of 25 minus 25 up 84, so a total of 58% return. That's pretty good money. 58% return. And you don't have to realize, again, we're not going to realize the 25% loss till after we die. So we got a yield of 81%. That's a lot of money. But land, Tesla went up 300% last year on the gain. Well, actually it didn't. It went down 25% last year. And we still made 84%. That's that little calculator I showed you last week, right? We come into the break-even calculator. And you can see that when you put the little break-even calculator in here at 0, you say, okay, Tesla, this is Airbnb. Let's do Tesla. TSLA. Tesla made $0. Well, the yield max fund still made $11,000, $10,000 on a $10,000. I think this is set at $10,000. So total reinvest $11,000, total cash out $10,000. So you still made $10,000 even though Tesla made nothing. So you realized it. Now, let's say Tesla loses money. All right. So Tesla lost a bunch of money. Now, even this one lost money now if you do that. If Tesla loses 50%, oh no, cash out, reinvested, we still made $7,800. We still made $7,800. Even if Tesla lost 50% of its value, the TSLY money would have still made you $7,000. Cash out 7,000, gain, it still lost 2,000. So no, if Tesla would have dropped and lost 50% of its value in 1 year, you'd have lost $2,000. So where's that break even? Right here. We'll go up to about right there. Okay. So if Tesla lost, what's that percent? 14%. Then that's where you break even and don't make anything. Anything below it. Tesla loses 14% of its value in 1 year, you break even with the TSLY fund. Pretty crazy, isn't it? All right, so that's how it works. All right, so now I wanted to show you. I've got $20,000 sitting on the sidelines that I need to put into the market if I want to. That's the thing. As I started out the entire thing this morning, when we first started this class, I was like, okay, we don't want to reinvest we don't want to drip our dividends, right? No dripping our dividends. We want to reinvest them strategically. So how do we do that? Well, we want to come into our portfolio. I'm going to come into my UBI portfolio. This is my open positions. So let's let that load. Come on, buddy. There we go. So that's my open positions. You can see since I did my rebalance, the market's shot straight up for me. Look at that. My rebalance was good. I was going in this trajectory. I did my rebalance, and now look at my market. Really good. So that rebalance has helped me out a lot. Okay. So now I have 20 grand that's sitting on the sidelines that I've received in the last week, and I need to put it somewhere. So where am I going to decide to put it? Now I've already got a portfolio full of stuff, and here's what's in my portfolio. Here's what it is. I've got NVIDIA, Tesla, Coney, OARK, BD, Hui, Snowy, NVIDIA, Tesla, Biddy, Misty, Palantir. So that's what I've got my distribution, and it's showing you that my distribution is 25% in Palantir, 16% in Biddo. Misty, it's showing nothing, but that's not. This is because I took it out. I took it out earlier. Let's include in calculation. I'm going to put it back in. The reason I put it out is because I don't want to put any more money back in. I've got too much in Misty already. All right. So currently I've got 15% of my portfolios in Misty, and that's plenty. I don't want to put any more in there. Palantir's got 21%. I would like to actually put more Palantir in, but I don't know. That's just me guessing, right? Why would I guess when the computer will tell me what the best distribution would be based on relative performance? So I'm going to go relative performance. We could do equal outcome, equal diversification, but I'm going to do relative performance. I've got 25,000. Is that what I've got? Hold on, let me check. I could go back and look. I was just looking at my brokerage account. I got 20 in that account and 5 in that. I do have 20. I got 24,000. So I got $24,000 that have just been paid out to me. Now I could come in here and say I want to do it by price gain, dividend yield, combined gain plus yield, or most recent dividends. I want to do it by most recent dividends. I want to see what's been paying the highest dividends to put my money in there, right? So I hit apply that, and it tells me where to put my money. It says put 2,000 in Coney, put OARK, put 1,600 in there, put BD, put 1,700. This is all based on the relative performance and highest dividends. So where am I going to make the most money by putting my money in there right now? And that's the distribution I should put. Now I can come over here and save that as my target. Come over to my group calculator, and I can say I got my 20, change that to 24,000, and I can say calculate my investment, and that's that's where it tells me my money should go. I should put 9,000 in Coney, OARK, BD, 4,800, and then it's saying don't put anything in Snoy, Nvidia, Bitto, Misty, or Palantir. So the first one, this one here, is if I was going to be putting money in fresh into these markets, but since I've already got positions in them, I'm going to come over here, and it's going to say this is where you should be putting your money based on your settings. So the highest dividends are coming out of Tesla, Hoy, BD, OARK, and Coney. And that's the distribution it's recommending right there. So now it's saying don't put any money in Snoy, Nvidia, Bitto, Misty, and Palantir because their dividends are not that high. Now I want to take into consideration what we were talking about earlier, which is the market itself. So now I need to come over and look at Coney, ORC, BD, Hoy, and Tesla. So let's go look at Coney. So we're going to go pull up Coney, and I'm going to say Coney. It says I should put money in Coney. Should I? I don't have to, just because the calculator says I should. I can come and look and see, well, do I want to be putting any more money into Coney? Coney's still tied to Bitcoin. I'm not really interested in putting any more money into Bitcoin. So it's telling me to put money into Bitcoin. I can come back over here to this one, and anything that's tied to Bitcoin, I can eliminate. I can move out. That's what I did before, right? So Coney, I'm going to take that and exclude from the calculation. I'm going to exclude from the calculation Bitto. So we're going to exclude that one. And I'm going to exclude Misty. So now it's saying, well, if this was your portfolio, this is where you would put your distribution, your starting distribution. We're going to save the target on that one. We're going to come back over to our group calculator, and it's saying, okay, now you should put, oh, it's still saying Cody. How come I didn't get my new, calculate. So I hit my calculator. Now it's saying I should put OARK by 3,925 of OARK. BD, I should go 3,700. BD is still Bitcoin. I got a lot of Bitcoin. I need Bitcoin to go up. Okay, we're going to go in and we're going to exclude the BD too. So take BD out of my list. Okay, so now this is what it's saying I should have my portfolio in. I'm going to save that target. Come over here to group calculator, and this is recalculate. And now it's saying I should put all my money in OARK, Hoy, and Tesla. That's where it says I should put my money. So I'm going to come over and look at OARK. So we'll come over and look at OARK. Now we're going to look at the underlying, right? We don't want to look at the actual OARK itself, which OARK is, there's OARK, but OARK is ARK, ARKK. So that's this one. Do I want to put money in this one? No. I don't want to put any money in that right now. Why? Because I think we're in a drive 1, drive 2, come in here, little drive 3. We're going to come back in ABC pattern back in here somewhere. I don't want to put it in there right now. So I can say, no, I'm not going to put it in right now, even though it says that's where I should put my money. It's saying that's where I should put my money because it's got the highest dividends paying out, but it's flushing. So even though when I come and look at ARKK or OARK, it's not that the gain isn't important. It is. I don't want to lose my gain. So I'm going to be strategic about putting my money in. I'm going to wait for the gain to rise. But I also have to take into consideration that I may miss a dividend by doing that. So OARK is paying out a 37.73 with 12% loss on the gain, 50% on the yield. 37. So then I need to take that into consideration. Am I going to lose out on money by not putting it in? Or is the gain going to be better for me enough to offset the yield that I'd be losing? 12 minus 50 is 37. I'd be losing 37% of a dividend of whatever I put in. I lose some on the gain, yep, because the market's flushing, but I'd make it back on the yield. But if I'm trying to maximize both, I want good gain and good yield. Well, the yield's kind of solid. The only thing I got control over is the gain. So I'm going to play against good gain. And that's what Rock was doing. He's trying to find better gain. But we got to be careful not to move from higher gain, but lower yield. Not that we want to have everything in one market either. We don't want to just be, oh, well, the best yield and the best gain is this one. We'll put 100% of our entire portfolio into one thing. We don't want to do that either because we need to diversify. Because the markets are fickle and they jump all over the place, right? Some markets are up, some markets are down. And so if you get like 10 of them, I like to be right around 10, then that's going to kind of keep an equal or a more equal balance. So what were we in? Now, what was it? Now I've lost my asset. Oh, now I lost my calculator. There it is. Okay, so we had ARC, HOY. Let's go look at HOY, HOOY. Now, HOY is hood, so we can look at HOY. That's the yield max version, but hood is the one we're most concerned about. And again, it looks just like OARK. We got our little wedge pattern in here. We went into that third drive, and now it's flushing out. This could be a new one drive. I mean, you could say, well, it made a drive. It goes here. Now we're going to start a new drive. We just do a new little ABC pattern. Maybe, but I want to see. I don't know. And I think that market might flush back down into this red line in here. And that's where I'd be more interested in putting my money. So then we come back and do the next one, which is TSLY. And we already looked at that one, TSLY. We look at TSLY, which is the yield max version. We pay no attention to this one. We don't really care what it's doing because we care about this one. And we think it's going to come back. So I could wait a little longer, but after realizing I'm going to lose out on a dividend if I do, but am I okay with losing out on a dividend so that I can get a better NAV, right? Get a better gain. It's all a game you play. So I've got 25,000 sitting on the sidelines. Where am I going to put it? I'm going to put it into one of these three. I'm going to put it into these three markets right here. OARK, HOY, and Tesla. But I got to time it with my dividends, and I got to calculate and decide whether I want the dividend or whether I want a better gain. On my total portfolio, well, let's see, I got to come home over here. My total portfolio, my UBI portfolio, let's just do the UBI portfolio because that's my big one. And then this is my traditional IRA. That's my second biggest one. Current value, the net value. Let's come down here. This is where it shows better right here. Total dividends. So this year I've received $331,000 in dividends, and I have total trades of 77,000. So I'm down 77,000 on this account this year, all right, in the gain, but I'm up 331,000 in the dividends. Did I make a good choice? No, I lost $77,000. If I look at my account on my little phone, where I'm looking at my account, right, my account balance, it shows I have a $77,000 loss. Actually, no, that's not the end. We got to go to the end. Yeah, $77,000 loss. So if I'm looking at my trading account, it shows a $77,000 loss. I'm like, what the hell? Lan, you suck. You're not a good trader if you lost $77,000 this year. That's because it only shows the gain. It doesn't show my yield. That's why we have to have a different program. That's why we have to have Portfolio Matrix to show us our yield. I actually made $331,000 in dividends. I have to subtract the $77,000 from that if I want to, which gives me $163,000 or 31% return this year on this portfolio. That's pretty good, 31%. I'm going to do better next year because now I have better tools. All right. I did all that by guessing. Now I got better tools. I got Portfolio Matrix. Now I can do better math. More better. That's good to have, right? More better stuff. So now total dividends, 331,000. I lost 77, but I don't have to realize any of that 77 if I don't want to. I'll wait till I die to realize the 77 and just keep the 331. When I die, I'll realize the 77. How's that? I'm not going to ever realize that 77. I'll just leave it on the books until I die. When I die, I don't care what happens to it. Well, my wife might. So she's not going to realize it till she dies. She'll just keep living off the 331,000. They'll give her 331,000. She never has to realize the losses of 77,000 until she dies. Who cares what happens after we die? We had the 331,000 that we spent all the way through. That's not a good way to look at it, Lan. Okay, look at it however you want. I don't care. That's how I'm going to look at it. I tell you, when you come here, I'm not telling you what to do. I'm telling you what I'm going to do. Now, I might change my mind, but right now, that's why I'm thinking about it. All right. So total dividends, 331,000. Return of cash capital. So far, they've given me 74,000 back. In 2 months, they will have given me 100% of my entire investments back for the month, for the year. I think I'm on the year. That's right. Yeah, 1 year. So this is what I get every month. So every month, monthly, I'm getting about 20,000, 23,000, 42,000. I got 42,000 that month. 23,000, 23,000, 26,000, 20,000. That's just out of this account. I got my traditional IRA too. Pop in there. Open positions. Let's see. That'll load here real quick. I'll show you what we're making in the IRA every month. Come on, load up, load up, load up. There we go. Okay. So in the IRA, we're making 18,000 in that month. Oh, that's quarterly. So 6,000, 6,000, made 12,000 that month. Not 6,000, 6,000, 12,000 in that month. 9,000. So for a total of 77,000 so far this year out of my traditional IRA. That's not bad. All right, $77,000 a year on my IRA and out of my UBI portfolio. Now remember, on the IRA, I don't have to pay any taxes on that. So I want to get as much money into my IRA as I possibly can. So the minute, like January 1st at 1 o'clock in the morning, I mean, the minute the very first trading day, I'm going to put the maximum amount of money out of my UBI portfolio, and I'm going to put it into my IRAs. So I got 2 IRAs. I just barely qualified for a Roth because I got married and sold my business. So now I qualify for a Roth. First time in my life I've ever qualified for a Roth. So all my money was in my traditional. So I'm going to put as much as I can into traditional, as much as I can into Roth, and I'm going to do it on day one so I can get all that money get as much money out of my UBI account, which has to pay taxes, into my non-taxable accounts, and run all as much money over there as I possibly can get in there as fast as I can. All right, guys, that's all I got for you. I got so much more I want to talk about, but you know what? I'm long-winded, and we've already been here a very long amount of time. Hopefully, you guys who stuck around learned something. And the only thing I got left for you to say is pick up Pitt News Magazine. That's the one thing that we do here that's most important. Of course, I use this software.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, that's it, guys. And if you want to talk to me in person, you can. I'm here for you in person. All you have to do is scan that little code or go to landturner.com, and I'd be happy to talk to you in person. Just me and you, one-on-one, help you set up whatever it is you need to set up with. And that's it, guys. I'm going to let you go. We'll see you tomorrow afternoon at 1 o'clock for Power Hour. Next week, we're going to be live in St. George at the university. So come and join the university classes. We'll talk to you about that later. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.